How would you like to take the stock that you already own and generate income with it? Well, you actually can by using options. Wall Street players do something called writing covered calls to generate investment income, but we as individual investors can also benefit from this simple option strategy. If you've never done this before, you're going to love it. In this video, we want to teach you how it works in a very simple way and then turn you loose making money. A beginner's guide to writing covered calls. This is the MoonShot Money channel. I'm Chase Vickers. Are you ready? Let's go. Welcome back everyone, and thanks so much for watching. Subscribe if you haven't already and help us out with a thumbs up. It really does help so much with the algorithm, and we very much appreciate the like. This video is for entertainment purposes only. So what is a covered call? You are entitled to several rights as a stock owner, including the absolute right to sell your shares at any time at the current market price. Covered call writing sells that right to someone else in exchange for immediate income. What this means is the buyer of the option gets the right to own your shares on or before the expiration date at the predetermined price, which is called the strike price. The cool part is you get to pick the strike price. And if you choose a price high enough, you can have an 85 or 95% chance of keeping your stock and the income that you've made. It's actually very cool. You just really need to own 100 shares of the stock. One call option contract is for 100 shares of stock. If you use Robinhood, this can be done very easily. Just get an approval to options trading and you're on your way. A call option is a contract or selling a call which gives the buyer the legal right, but not the obligation, to buy 100 shares of stock at your strike price. The buyer can do this at any time, on or before the expiration date. If the seller, you, of the call option also owns the underlying stock, which we recommend, the option is considered covered because you can deliver the shares without purchasing them on the open market at possibly a much higher price. You really want to be covered or own 100 shares. The buyer pays the seller of the call option, you, something called a premium to own the absolute right to buy your shares at the predetermined future price that you get to pick. The premium is real money paid on the day you sell the option, and that money is yours to keep, regardless of whether or not the option is exercised or not. So think about this. A covered call is most profitable if the stock moves right up next to the strike price. That would generate growth from the long stock position, just like normal, but the call would expire worthless, allowing you, the call writer, to do whatever you want to do with the cash. Basically free money. Keep the stock and keep the premium. When you sell a covered call, you get paid, but you give up the portion of the potential future upside. For example, let's say you buy Palantir for $23 per share, believing it will rise to $50 within 1 year. You're also willing to sell at $45 per share in the near future, almost doubling your investment. By selling a covered call, you give up further upside, but you'll take a great profit. Here's something you'll love. You can also pick how long the option lasts, like a week, maybe a month, or 6 months. The stock's option chain might tell you that selling a $45 6-month call option on Palantir will pay the seller $3 per share. You could sell that option against your shares, which you purchased at $23. Writing this covered call creates an obligation to sell the shares at $45 within 6 months if Palantir reaches that level. You get to keep the $3 in premium per share plus the $45 if someone exercises the option, for the grand total of $48 per share. Your cost would be $2,300 for 100 shares, and your total return would be $4,800 in 6 months. That's over 100% return. Not too bad. If Palantir just stayed at $23 in 6 months, you would keep the $300 generated from selling the $45 call. That's a 13% return in 6 months if the stock doesn't move up at all. You could also look at the $300 as reducing your cost basis from $2,300 to $2,000, and then you do whatever you want with the money. You can pay your cell phone bill if you want to. Remember this though, If you sell a call, you have to hold on to the shares until the expiration date, or you'll be holding what's called a naked call, which theoretically has unlimited loss potential because the stock price could go to the moon and you'd have to buy it. So if you sell a covered call, you should hold on to your shares. So here's the bottom line. You have to look at it two ways. You can, one, use covered calls to lower your cost basis, or two, generate income from your shares, which you can use to buy more stock or buy groceries. It's a win-win. If you own 100 shares of the company, you can give this a try. A good way to experiment would be to sell a covered call expiring in 1 week. That's called a weekly call. You will collect a small amount of money, and if the week passes with the stock price below the strike price, you keep your stock and the income. One little way we play this for a kind of free share of stock is to sell a weekly covered call and enough premium to buy a single share of stock we like, while not expecting the stock price to reach the strike price in just 4 or 5 days. Here's an example that I did just last week. I sold a covered call on 100 shares of Blink charging stock that expired in 4 days. The call was $8 above the current price. I collected $24 for the call. I immediately took the money and I bought 1 share of ARCX. This was literally like getting a free share of stock. The Blink price didn't get close to the strike price. We can do this over and over each and every week and actually pick up 52 free shares in a year from simply writing a weekly covered calls at a high strike price. We are certainly not financial or tax advisors, and this is just for educational and entertainment purposes only. If you would, please help us out with a thumbs up. And if you're not subscribed yet, we would love to have you join our community so you never miss one of our new videos. Earn more, save more, invest more, and give more. And remember, if you're not interested in your money, someone else is. We hope you have a great day, everyone, and we'll see you on the moon.